Welcome Pure investors, I'm Nick and this is your May 2022 update for the Pure Income and Growth Fund. The fund delivered a negative 0.5% return in May, which, whilst disappointing, provided meaningful capital preservation for investors in what was a very tough market for the month. And it was a tough market. The ASX Small Caps Index fell 7.5%, and as a consequence, most equity-only investment funds have now given up all the gains made since the COVID sell-off lows in early 2020. This trend has continued into June, and as the market continues to price in a variety of macro news, which is culminating in more volatility and a dearth of buyers. The question is, when will markets have factored into equity prices the bad news that is known, and also the fear for the bad news that may become apparent? This pricing conundrum is being compounded by valuations. Equity markets have been running hot for a long time now, and valuations, especially tech valuations, have been too high. And more or less everybody knew it. Equity investment management, though, is a structurally flawed industry, because most funds are vanilla equity long only. In other words, they don't hedge. As a consequence, even if you knew prices were too high, as a responsible manager, you couldn't risk being out of the market because prices could have gone even higher. And in rapidly rising markets, if you aren't playing momentum, you will underperform, which is a business risk. Consequently, most professional managers prioritize their business performance over their investment performance. Dare we say it? Despite their misgivings on valuation, they ride the momentum whilst consoling themselves that all they have to do is perform better than their peers. Being an equity manager is a bit like the old joke about the two hikers and the bear in the forest. You don't have to worry about outrunning the bear, you just have to worry about outrunning your fellow hiking companion. There is too much business risk to move too far from the pack, even if you know the pack is wrong. This is not Pure's model. Our credit-based approach to equity investing is one continuous hedge. When we make profits from equity performance, rather than reinvesting those back into equities, we are distributing the profits back to fund investors and reinvesting the base capital back into secured debt that has equity upside. Now, that being said, we're not immune to market weakness, of course, but the impact is considerably mitigated, as can be seen in this rolling 3-year chart. Whilst the index is down over the 3-year period, Pure is up approximately 70%. Now, if we consider performance calendar year to date, the index is down 18.5%, where Pure is flat, demonstrating the capital preservation strengths of our approach, that continuous hedge that I referred to earlier. Moreover, weak markets present significant opportunities for better pricing in both new deals and within the existing portfolio, as access to capital, rather than the price of capital, takes precedence in the minds of executive teams and boards. Pure's transaction pipeline today is approximately $72 million versus approximately $26 million this time last year. We have a significant opportunity today to create enormous value in the years ahead for our investors. But are we getting value in the current market? We think we are. This chart shows the share price falls of the companies that are currently under review, the $72 million pipe that I spoke to. Historically, on average, the fund has charged a 10% interest rate with conversion at a 70% premium to the prevailing share price. Even at this historical premium, to make equity profits in addition to our interest income, we will have 3 to 4 years for company share prices to return to the level equity investors were paying for those companies just in the last 12 months. So now let's talk about how the fund is holding steady in these challenging market conditions. The Pure model is designed to deliver superior risk-adjusted returns through the cycle. Although we are unlikely to keep up with equity beta during bull markets, the ability to weather downturns is central to our strategy. And it's now unequivocally demonstrated through both this market correction and the initial COVID market correction in February and March of 2020. Today's market conditions offer little enjoyment for anyone, Yet we are genuinely excited about the opportunities being presented to the fund. It's difficult to say whether now is the time to buy equities, but we can say that value is emerging and the opportunity set is significantly up. Although we are bottom-up investors, we are not ambivalent about markets and economics. We have been bearish on equity markets since the second half of last year, and as such, we have tried to position the fund accordingly. We've done this in several ways, through taking a more conservative approach to the valuation of warrants, maintaining an overweight cash position relative to target, and finally, where possible, trimming our equity exposures. Although, like all equity investors, we have suffered a pullback in the value of our equities and warrants, we have been able to offset these losses through interest income, facility fees negotiated as part of transactions and paid into the fund, and an uplift in the value of an unlisted investment to reflect the pricing of a material capital raising that closed in June, led by a new external third-party investor. Nevertheless, you're not paying us just for capital preservation, but rather to make you a return on your capital. So be reassured that this is what we expect in the coming 12 months for the following reasons. Firstly, our interest income returns are trending higher. Current markets are enabling us to realise higher interest rates on new facilities, with, by way of one example, a maturing 8.5% interest rate facility about to be replaced by a 12% interest rate facility. Secondly, the fund would participate in a market recovery should it eventuate through its warrant and equity exposures. Third, there are several catalysts in our portfolio companies. Fourth, most of our unlisted investments are still held at the value of the debt only, despite having embedded equity value in each position. And finally, many of the deals available to us today are the most attractive transactions that we have seen since we launched. Turning now to fundraising. Market conditions have become extremely favourable to Pure's convertible debt investment strategy. We believe equity-like returns can be earned via credit instruments, possessing upside optionality. As such, both of Pure's funds are actively raising capital over the coming weeks to facilitate closing unprecedented transaction pipelines. We are determined to capitalise on current market conditions for our fund investors. If you would like to invest with the Pure team, please access the online application form via the Olivia 123 link in this month's newsletter, accompanying this video. And should you have any questions ahead of considering further investment with the fund at this time, please don't hesitate to contact us through the usual channels. The greatest compliment our investors can give is the referral of friends, family, and associates. If you know of other investors who are seeking opportunities in this unusual market, please feel free to make the introduction. Thank you for your time, and we look forward to updating you again in July.